I mean, it was such a volatile year for oil, which ended down 20% on the year. What will drive prices in 2021? Will it be the vaccine?
Well, you have to be very careful, Haslinda, because the vaccine, when we first got that initial announcement from Pfizer and BioNTech in early November, I sensed the initial reaction was rather one of irrational exuberance, to borrow former Fed Chair Alan Greenspan's term. We've been living in a dungeon for so many months. That first ray of light is very warming, but be careful not to overreact. I'd say we're going to be fixated on vaccine volatility, especially with the news of these more virulent strains coming out of the UK, Europe, Africa, the news of more intense lockdowns in major urban centers. We're dealing, normally oil markets, we're used to dealing with things like overproduction, non-OPEC output, fracking, shale oil in the States. But this time the adversary is a force that is new and different and demands a different response. So I think we're going to all be fixated on two things. It's really the course of COVID, and secondly, the recovery in the economic sector. Where are we going to see how fast and how will be the recovery of this massive demand destruction that we saw in the wake of the COVID virus?
So, John, given expectations of uneven recovery, what should OPEC do? How much oil should it put back into the market?
I think actually in the last year, OPEC has had what a volatile time. I mean, you had the oil price war on March 3rd, 4th, 5th, when you had a falling out between Russia and the Saudis. You can't afford to do that again. There's got to be compromise. There must be a deal. But I think what we've moved into is kind of a supply side micromanagement, where you can't set a policy, we're going to cut this amount for 6 months, we're going to restore this amount. What you really got to focus on is tweaking this almost in a micro way every month. Now, in December, it took them 5 days. You had a standoff, and you're starting to see some new fractures within the OPEC alliance. The UAE spoke up, a bit frustrated about some of the constraints. And you have to contend with these things like these compensation cuts, where basically anybody who's overproduced has to make it up. You also have to contend with factors like Libya. They've been exempted from the production cuts. And lo and behold, in the fourth quarter, they went from about 75,000 barrels a day to over 1 million barrels a day. But then again, the civil war in Libya, General Khalifa Haftar, this is all very tenuous and fragile. So you've got to be agile, resourceful, responsive, but you only want to bring enough oil into the market so it doesn't upset this very delicate balance. If you put too much oil in, the price could go down. If you cut back too severely, the price goes up, and that waves a red flag to non-OPEC producers. It's all about market share these days and protecting the key markets in Asia, China, India, ensuring that those get the primary flows from OPEC Plus and not from other producers.
John, given the year that was, has the oil market changed? Has there been a paradigm shift when it comes to the way that crude oil is being, consumed, perhaps also supplied?
Paradigm shift, Rishaad, is the right word, inflection point. There are new rules. There's a new playing field. And as we speak, I think what we can do, they always say hindsight is 20/20. I think most of us are glad to have 20/20 behind us now. But we still are seeing a shakeout, an almost Darwinian disruption where it's survival of the fittest. And not only the upstream, you saw a number of U.S. producers either go insolvent or they got taken over. You look at the midstream, the downstream, the refiners. You've had refinery closures. Even here in Singapore, the biggest refinery, Shell Pulau Bukom, cutting by 50%. Other refineries closed for good, either mothballed or converted to terminals. So you've got a new paradigm in that there's a new kind of playing field. the older, less efficient refineries, they can't exist anymore. They are, and you saw a similar process after the financial crisis, but I would say arguably it's more intense this time. So this shakeout is still continuing, in the wake of the COVID virus and the oversupply that we had to deal with in 2020. I don't want to look too far forward. Some companies even say, well, we've passed peak oil demand. Look at what the incoming BP chief, Bernard Looney, has said. We've already passed peak oil. You've got others like ExxonMobil and even OPEC saying, no, peak oil is still further down the road. Well, you've got a number of different scenarios that all are going to have to play out. We'll just have to wait and see.
John, I'm going to bring up a chart. You won't be able to see it, but the question, irrespective, remains like this. Brent crude, if you have a look at that, this chart shows this 3-month time spread. It's sending uncertain signals. It's been neutral for more than a month, and it's tipping into backwardation again, I should say. And is that significant? And just backwardation, of course, is when we have oil markets seeing deliveries in the near future having a higher price than those made down the line there as well, just for clarity.
It is significant, Rishaad, because backwardation, we in the oil patch, that is a seller's market. This tells you you're collecting a prompt premium for the oil. Do not keep it in a tank. Do not carry your inventory. Sell it, drain your tanks, draw down inventories, monetize it, because right now the prompt is commanding the premium. And to the extent that the market structure, the backwardation even steepens, you not only will have this incentive to draw down inventories, but on the investment side, you'll have a lot of companies that will be what we call playing the role. You can earn passive income because prompt oil is at an elevated price. You simply, if you're an investor, you sell the front, buy the back, and play the role. So this would be a very supportive, encouraging signal for markets. In fact, I think OPEC at the end of the day would like to see two things. It would like to see drawdowns on global inventories below 5-year averages, and they would love to see a return to backwardation. But bear in mind, you don't want it too overdone, and you don't want elevated prices, because if prices start moving up, that is waving the red cape to the other producers, particularly in the United States, although I'd argue shale and hydraulic fracking, they're less resilient. They're going through a consolidation phase right now.
John, the consensus in the market is for a weak dollar in 2021. To what extent and for how long can the weak dollar support oil, support commodities?
Well, Haslinda, I think it's going to be with us for a while because the stimulus, quantitative easing, monetary fiscal policy, the Keynesians, that's all essential. This is the near-term infusions into the market to keep it afloat, to deal with things like unemployment, lack of mobility, lockdowns. This is anticipated. You've got Janet Yellen coming into the Fed. You can count on that to happen. And one of the effects of that is currency debasement. A weak dollar, because oil and energy are globally denominated in terms of dollars. This is going to be supportive. This is going to, put a pretty solid floor under prices. But you can't count on the stimuli, the quantitative easing, being long-term permanent solutions. They're just supposed to get us through this period of adjustment. We're looking at Q1. We're worried about speed bumps, about possible demand slowdowns in the wake of these new strains of coronavirus and more lockdowns. What we're even starting to see is talk of inflation rearing its head again. And if you look not even beyond oil, at other commodities, metals, especially copper, they're hitting highs. This is a sign that this economic recovery, aided by the fiscal stimuli, it's a rising tide that's raising all boats. How much and how fast? Well, you've got to have multiple scenarios for that, depending on what happens with COVID.